Hello, everyone. Thank you for joining today's web conference, our CNR 2025 March Market Update. My name is Elizabeth Dooley, and I'm a Senior Portfolio Manager at City National Rockdale. I'm joined today by key leaders from the CNR Investment Strategy Committee, including our CIO, Charles Luke, Senior Economist, Senior Portfolio Manager, Paul Single, Head of Fixed Income, Michael Taylor, and Head of Equity Strategy Management, Joseph Hendelman. The views and estimates you hear today are sourced from our investment committee's weekly meetings. During today's call, we will discuss CNR's perspective on what's in store for the economy and financial markets, and also implications for client portfolios. At the end of the presentation, we will all be on the line to answer any questions we receive from you during the webinar, so please type them into your console's Q&A window at any time during the session. You can also download the presentation materials using the resources window on the right side of your console. I'll now turn the call over to Charles Luke of City National Rockdale.
Great, thanks Elizabeth. And I'm really excited today to have the full team here. And this is going to be the first time that everyone gets to hear from Joe Hendelman, who joined us last year as the head of equity. So lots to discuss today. What we wanted to do was last webinar, we talked a lot about policy impact and focused on the tariffs. Today, we're still going to talk plenty about that, but we wanted to bring our market views and positioning back into play. So you'll hear from Mike and Joe on that front. So to get started, to take a look at our speedometers, there are a lot of shifts here that happened in March, and we did make some shifts yesterday on the investment committee, so you'll have a little bit of an April preview. But what I want to do before I start going through these is emphasize the underlying fundamentals of where we're starting here are positive. So consumption remains high, we're above full employment, corporate profits are above average. And in fact, we just got the Q4 GDP numbers. They were revised up this morning, and price indexes were actually revised down. So those are both good indicators. But just because we have positive fundamentals doesn't mean that expectations can't change the picture over the year. So if I had to pick one of the biggest risk factors we're seeing in the market right now, it is the negative confidence and the sentiment that is out there. And we're going to discuss that extensively today. So overall, we have about 6 changes between March and April that have occurred with the speedometers. And let's start with March. So we've made 5 adjustments overall. First, taking a look at real wage growth, which does remain over 1%, and positive consumer balance sheets, we have moved disposable income up a notch. So just a little bit to the right, no change in the color yellow. Second, we do believe that the housing market, with growing existing inventory of homes and high mortgage rates, could begin to slow its contribution to GDP. But our biggest question here is, will continued slow activity in housing start to take a bite out of consumer spending? So we haven't seen that yet, but it's a big risk factor. We also continue to feel very positive about low crude oil prices and the administration's goal of keeping those prices low. For all of the potential pressure on inflation from tariffs, this is an offset to high prices. And now I know the next 2 are controversial. So let me just say, let me start by saying we're not taking a political view here or endorsing the president's policies. What we're trying to do is cut through the noise and evaluate the shifts that we're seeing. So we've made 2 changes that result in slight upticks to both the political environment and geopolitical risk. Note that both colors are remaining the same, so yellow for political and red for geopolitical risk. So if we take the political environment side first, what we're focused on is the volatility involved with the legislative process. So purely, how easy or hard is it to get legislation through? So our conclusion is that despite the potential results of the policy over this year, a Republican-controlled House, Senate, and presidency has resulted in swifter policy change. And we're basing that on the continuing resolutions for both the budget and the push out of the potential for a government shutdown on top of early signs around the tax bill. So once again, this isn't an endorsement of policy, but an analysis of the legislative process. Now, on the geopolitical front, this one's a little bit more simple. Yes, we do see Russia taking a hard line in negotiations on the ceasefire, but we do think that the open channel of communication between Russia, Ukraine, and the US, and to a smaller degree Europe, is a positive development overall in the landscape. So again, both these areas have not changed colors. They are very small moves, but our investment committee concluded that we did need to acknowledge these changes. So the latest shift hot off the presses for April is consumer sentiment, and we have downgraded that. The overwhelming reality is that sentiment has remained depressed over the entire post-pandemic surge in activity. And given the policy uncertainty, we don't believe this is going to change at this point. So sentiment had previously been on a positive trajectory, but damage certainly has been done. We don't see this moving above long-term averages anymore, and we will have other sources of volatility later this year. That includes the debt ceiling situation that we're likely to start seeing pressure on in May, and the potential for a government shutdown in September. So these issues are likely to continue to weigh on the sentiment picture. So the next element that we're thinking about with these changes on the speedometers is what's the flow through to our forecast. So if we back up to a high level on tariffs, we now have 19 targeted countries and 10 specific products that have been mentioned, implemented, or discussed by the Trump administration. More recently, what we're hearing about today is that the White House did sign a proclamation that implements 25% tariffs on auto imports, and that's going to go into effect on April 3rd. We also had Trump reiterating his intent of imposing tariffs if the EU and Canada continue to do economic harm to the US. Now, those are Trump's words, not mine. So we're still living in an environment of tariffs every day. So that's going to be the norm. There's no question about that. But my follow-on question is, how do you make assumptions about the overall impact and the longevity of tariffs? Because the reality is this could change, and it could change overnight. It could change during the day. So we don't know, and we can certainly see it move on a dime. So what we wanted to put together for everyone is take our forecast from February and then add in the potential tariff drag, which is largely consistent with what we did say in February. So we see an impact on GDP growth from what could come of about 0.3 to 0.5%. And that equates to about $100 billion off of the run rate in US growth, which at a 2% level is around $470 billion per year. We've also seen more of a downward trajectory in overall analyst estimates for EPS and expected earnings for corporations over the past few months. So we had warned that very high 2025 estimates were at risk, and they've now dropped to just shy of 10%, which is still very positive and above average, but they are moving a little bit lower. So we see the maximum impact from tariffs for the whole market at about 4%, and that considers no additional shifts in deregulation and tax policy. And as we discussed back in February, the inflationary impact is likely to fall somewhere between 0.4% and 0.8%. And we're now expecting it to be a little bit closer to the top end of that range, about 0.8%. So that would put nominal consumer price inflation, or CPI, at about 3.6%. So that means that for areas of the market we think remain wise choices are some of the value-oriented position and defensive stocks. So it's important for us, even though we might lean into some of those, to maintain exposures to some broader growth names. And while tech has struggled, we continue to believe it's subject to pops to the upside and should continue to be a core holding. As far as interest rates, we don't expect our forecast for the 10-year to change. We're 4 to 4.5, and we've been solid in that range for some time. And we don't expect Fed funds, the 1 to 2 cuts that we had previously, to be impacted. So we're very comfortable with those ranges. So let's jump back into the market and some of the signals that we're seeing. First, I think this is a great chart. We often find ourselves in situations trying to explain the difficulty of exact market timing and just how important it is to stay invested. So if we take a look at early March, the market did experience a textbook correction. So it fell just over 10%. It's now since rebounded about 4%. And it's hard not to be captive to the moment. And we didn't believe that allocation changes were warranted from that recent pullback. And this chart really explains why. So what's the cost of missing out on the best days in the market? We took a look at this over the past 22 years, going back to 2003. So the way to read this chart, if you start all the way on the left-hand side with the highest bar, that's a fully invested portfolio over that time frame. So it grew from about $1 million to $9.9 million over that time frame. If you miss just 10 of the best days, that cut the growth of your portfolio to just 4.6 million. And if you missed the 60 best days in the market, you lost about $600,000 of that 1 million initial investment. And note the complexity here as well. The top 10 return days on the left-hand side here actually happened during the last 2 recessions in 2008 and 2020. So that's periods when pressure is on and stocks are moving rapidly. So given that the sell-off a few weeks ago really lacked tangible underlying fundamental deterioration, we weren't going to risk the return potential for a reversal and a pop. So what are some of the top level items we looked at and used as a guide when the market turned back early March? So first, what we wanted to assess was what's the current level of unemployment and inflation, right? Going back to those fundamentals. And those are the 2 biggest concerns in the market right now. And what you're seeing on this page, let's start with the left-hand side here. The misery index, which is a terrible name, but the misery index measures the sum of unemployment and inflation. We also took a look at the 3-month trailing sentiment numbers, and you can see the misery index in blue and the sentiment index in yellow. What you want to see in the market is the misery index to be low, that's the blue, and the sentiment index to be high. And usually these are very negatively correlated. But that's exactly what we're seeing despite some of the recent deterioration in sentiment. So the longer term trend on the sentiment situation is still positive, even though we're seeing it hook down. But we're going to need to see persistent negative sentiment for a lasting impact on the movement of stocks. So we're definitely in the early stages here, and we are starting from a strong base. The second thing that we take a look at is how do we measure levels of volatility in the market? So one of the most common signals to use is the VIX index, and that just measures the volatility component of options. And what you can see here on the right-hand side is that we didn't hit the levels associated with the continued drawdown, and the spike was pretty normal compared to the pullbacks that we saw in 2024 and 2023, and the level did not exceed what we saw in 2022. It's also important to note that the level did return back below 20 very quickly, and that is a watermark for stress in the market that we pay a lot of attention to. So despite the chaos of the administration's communication during that week, it certainly was enough to spark a sell-off, but we didn't assess that it had the potential to really derail the trend with more longevity. So let's shift over to the sentiment question and really dive in on this, and Paul's going to have some detail on this as well. But there's no question that uncertainty, pessimism, and doubt are all very bad for the market. But often these issues are with perception. They're not the reality of the fundamentals. But what we're concerned about is that a negative environment can lead to a breakdown in those fundamentals. But I do have to point out that it doesn't usually work that way. So what we tend to see is that a breakdown in fundamentals leads to negative sentiment alongside of a decline in economic growth. So let me walk you through 5 periods since about 1978 where sentiment and confidence broke down, but a recession didn't ensue. So first, if you look at the yellow circles here on the chart, coming out of the 1990 recession, confidence fell during the early stage of economic cycle and the lift up in growth, and that didn't result in a pullback in growth. Second, if we look at the fallout from the Asian financial crisis in 1998, that led to a swift decline, again, without a growth impact. Other areas where we saw a similar behavior was with the Iraq War, as well as the debt limit showdown in 2011. And we have seen some pressure on sentiment and confidence in the post-pandemic economy. So the risk here, again, is that prolonged, very negative sentiment and changing expectations can hurt the environment. But we don't believe that all is lost, despite some of the uncertainty that we're seeing. So we're still focused on the net policy impact outside of just looking through the barrel right now of tariffs. So we're going to see a lot of head fakes from confidence and sentiment, and we have seen that historically over time. So let's drill into some of the main issues and risks with respect to tariffs and growth. And let's focus first on what's going to happen with unemployment. So on the left-hand side here, if you look at the mentions of layoffs and cuts that we see in the news, it did spike pretty substantially in February. But as the economy and as the general public, I think, has had more of an adjustment time to DOGE, that's quieted down a little bit as the initiatives continue. We're also seeing a high level of concentration of concern squarely focused on the Washington, D.C. region. And we do think that federal job cuts are going to be highly regionalized, not widespread, and certainly with little impact on the Southeast and Southwest. So let's take a look at government jobs on the right-hand side. If we think about the post-pandemic recovery, federal job gains accounted for about 12% of that growth, and that equates to largely about 1.7 million in job growth. So if we exclude those government jobs from the recovery, the average monthly gain since the pandemic would be around 300,000 jobs. Now that's skewed from the immediate bounce back that we saw, but it is still significant. So cuts of 15 to 20% to the federal workforce on a total employment level of about 3 million equates to about 300 to 400,000 in jobs that could be cut over the life of the administration. So we do think that unemployment will rise, but it will rise gradually. And we do think that it'll be right on the long run full employment average, which is about a 4.5% level. So let's take a moment to dive a little bit more detailed into that estimate. And what we took a look at was the correlation between the unemployment rate and the actual level of job losses or layoffs. So we have seen a little bit of an uptick in that data job layoffs are running at about 2,500 per month. You can see that in that yellow dot. But if you take a look at this green trend line, this trend line has a correlation between layoffs and unemployment of about 0.8. That suggests that unemployment at this level of layoffs should be around a 4.6% type of level. So I'll reiterate again that I think job loss is going to be highly regionalized, and it will have a little impact on the majority of the country. But the one component that we have to take a look at is contractors. So I get that question a lot. So it's estimated that government contractors account for about 3 to 5 million in the workforce. But here's the thing with this, they actually aren't counted in the non-farm payroll headline numbers. So that doesn't mean that we couldn't see some sort of a growth drag from that component, but its influence may go more undetected. I also think it makes sense to conclude that a high proportion of government contractors, which typically can be skilled workers, may find other jobs. So I don't think the contractor issue is going to show up broadly in the data. That could be good for sentiment and confidence, but it could be a double-edged sword of leading to some pressure on the growth side of things. So let's go back to the inflation conversation. And I wanted to break down the overall impact in terms of imports, and I'm revisiting a chart that we used in February. So there's a great study and methodology that the Federal Reserve Bank of Boston put forward, and it tries to quantify this impact. So ultimately, if we think about direct imports, that's essentially finished goods, versus indirect, which are supply chains, kind of components of those supply chains, the influence of inflation on the personal consumption expenditure measure for imports is about 10%. So if we take a look at this chart, we see the largest impact on inflation from pharmaceuticals and medical products, garments, video equipment, recreation. If we take pharma alone, just to show you how this works, the graph shows that it's only about 1% in terms of its influence on the overall inflation number. So if inflation is at 2%, pharmaceuticals would be contributing about just 2 basis points to the overall inflation number. So that's very small. So inflation is going to come under pressure here, but we think of 10% of that is going to flow through to the actual level of inflation. So it's important to realize it's not one-to-one. So just because effective tariff rates are going up, it doesn't mean that those prices are going to transfer through exactly to the level that consumers are paying. So if we go back to our estimate on the forecast chart, considering an increase of about 0.8% of pricing overall, and looking at the Fed's measure here, if the effective rate spikes around 8 to 10%, a 10% contribution puts us at the high end of that level, depending upon how things go. So we do think that's a very accurate way to think about inflation. Now, the last area I want to talk about in my opening here, and I'll pass it on to Paul, is taking a look at the 1970s and this concept of stagflation and what the conditions were at that time relative to the conditions today. So that's certainly coming up a lot. So let's go through each one of these and just talk briefly about whether or not we see those conditions present. The first is that we had large levels of oil shocks. So in the 1970s and 73, we had the OPEC embargo, and then in 79, we had the Iranian Revolution. Those were both events that sparked both rises in inflation over the 1970s. If we think about the current environment, we did get an oil price spike after the Ukrainian invasion, but it wasn't sustained. And we do have an administration in place whose goal it is to lower energy prices. So that condition is not present in the current situation. We take the next one, loose monetary policy. We did see deficits get pretty high to finance the Vietnam War and a lot of the Great Society programs. And Arthur Burns was under a lot of pressure from the Nixon administration at that time to loosen Federal Reserve policy. So rates were kept low. If we think about today, there are some correlations here. So we do have very large deficits, and we're adding to the overall debt load of the government, and that's combined with quantitative easing from the Fed. The Fed has been somewhat successful in reducing that balance sheet, though, so that is a positive component. But we also have a Federal Reserve today that I do think is strictly enforcing their independence. So while deficit spending is similar, I think you have a much stronger Federal Reserve in place that's more independent than we saw in 1970. But if I had to pick one area, that's the biggest area where I think we have correlations between the 1970s. If we think about currency devaluation as the next one, the gold exchange system was eliminated, the Bretton Woods Agreement. So we came off the gold standard in the 1970s, and there was a significant amount of dollar depreciation. Now, we haven't seen that in this environment. The dollar has been largely stable, and it's being utilized as the core reserve currency in the world. So that condition is certainly not present. The next is wage price spirals and regulation. So we did have automatic cost of living wage increases and very strong labor unionization in the 1970s. Now we're facing a potential wave of deregulation, and there's much less labor unionization than we had. So that condition isn't present. And then let's take a look at productivity. So one of the interesting things about the 1970s was that productivity growth did slow. Now, productivity growth in this environment is very different. It's been rising, it's very stable, and technology advances through AI are likely to provide tailwinds as we move forward. So we don't see that condition as being present. So we're paying a high level of attention to what happened, and history matters, and we need to take it into account. I do think this situation is going to be very different as we move forward. So I'll stop my comments on the key takeaways here. The Trump administration overall does threaten in terms of policy to bring down growth and increase inflation. Well, I do think uncertainty remains the main driver here of a shift towards the negative sentiment. The drop in the equity markets happened quickly, but it does resemble a typical market pullback in our minds, and we have seen signs of a continued slide diminish. Consumer confidence and sentiment have often given us false signals. So it doesn't mean just because we have a negative environment from a sentiment and confidence perspective that we're hurtling towards a recession. Now, we see the main risks of a potential Trump administration policy as we went through as those higher price levels and higher unemployment. And we see many comparisons being made to the 1970s style stagflation, but we don't see many similarities between the 1970s and the conditions that we see today. So I will stop there and I'll pass it on to Paul for his update on the economic side. Go ahead, Paul.
Great. Thanks so much, Charles, and hello to all of you. Not to overstate the obvious, but the news from Washington has been very worrisome to many households on a couple of fronts. One, you're accustomed to the federal government moving at a pace not much faster than that of a glacier. So seeing quick changes in terms of policies or in terms of how the government interacts with the American people is something that they're not accustomed to. Secondly, is trying to understand what the final game plan is for an awful lot of these policies. Is it just a negotiating tactic, or is this going to be a long-term change? And as a result, we're seeing the survey data tell us that the news that's coming out of Washington is quite worrisome. And you can see that in the chart here on the left-hand side, where it's the news that's related to government economic policies. It's at one of the lowest levels that we've ever seen. We saw it once before. This was back in October of 2013. That was the big fight between Obama and the Tea Party. But people are concerned what's going on there. And that's flowing over in terms of their policies for the economy. And you can see that over on the right-hand side. This, too, is at very, very low levels, something that we're not accustomed to. Just a note there, the low that you see there in 2010, that's when the United States debt was downgraded. So people were quite upset about that. In terms of what this means in their overall view of the economy, you can see this on the left-hand side in terms of the total sentiment view of what's going on in people's lives, especially their financial issues. And you can see it's near all-time lows that we saw back in June of 2022. The chart on the right, now that's a little busier. This is measuring the 3-month change in the sentiment. And this, you can see the 16-point drop. That's the 8th largest drop that we've seen take place here. So clearly, we've seen a swift and dramatic move in terms of the attitude that people have towards the future. But I want to go back to the chart here on the left-hand side. The all-time low that we had in June of 2022. What was going on then? Well, the inflation had been moving up. So the Fed had already raised interest rates by 150 basis points by the end of June. The stock market, or the S&P 500 that is, had traded off almost 25%. Food prices were very high. They were running close to 14% year over year when people were accustomed to just 1 or 2%. And gasoline prices were at an all-time high. So that's why people were quite upset back then. But also pay attention to what happened since then. Well, we've had a pretty strong economy. Almost 7 million people have been added to the payroll. GDP growth has been averaging 2.9%, a very, very strong pace. The stock market's up about 50 basis points. Up about 50%, excuse me. All during a period of time when the Fed raised the funds rate by more than 300 basis points. This has been an extraordinarily strong economy since then. There's a big thing that we need to pay attention to with the sentiment data. There's a big difference between sentiment and what people actually do. Sentiment is low because of the feeling of insecurity and uncertainty. That does not mean we're going to see a dramatic change in terms of the economy. Keep in mind what Charles said earlier. The fundamentals of this economy are extraordinarily strong with a very low unemployment rate, great balance sheets on the personal and corporate level. And you also have a federal government that's adding a great deal of stimulus into the economy. But the issue that is a concern for market watchers, of course, is will this impact the economy? Because this economy has been driven heavily by consumer spending. The chart here on the left just shows the contribution that consumption has had to economic growth on a year-over-year basis. And you can see in the past 4 quarters, or throughout 2024, the most recent data that we have, it contributed about 85% of the growth, which is punching above its weight because consumption as a portion of overall GDP is only around 68 or 69%. But then we need to take a look at where the consumption has been. The chart on the right-hand side breaks it down into the 3 major components. Is it happening in services, which is about 2/3 of people's consumption, or is it happening in durable goods and non-durable goods? Keep in mind, tariffs won't have any direct impact on services where people do most of their spending. Where it will happen is on both non-durable goods, especially like food, and of course durable goods like automobiles. But as Charles showed in the earlier chart, the overall impact on inflation is all not that great. People think about things an awful lot, like how much more expensive a car may be. Remember, most of your money is spent on other things like your mortgage, insurance, those sort of things, and that you're not seeing them being impacted so much by the tariffs. But we're also starting to see a change in people's spending habits. There's been a little bit of fraying going on. This chart here on the left-hand side just breaks down a percentage of spending on either what is required in terms of things that you need and what is not required, whether it's discretionary or non-discretionary. And you can see that it was on a pretty stable trend for the 5 years before the pandemic, but it is starting to change an awful lot, in which case you see the non-discretionary spending, the light blue, is becoming a bigger and bigger share, which is versus a different trend. And that may make somewhat of a difference in terms of spending habits going forward due to the uncertainty. But on the right-hand side, you also see the impact that's going on in how the stock market views these sort of things. They call it something a little bit different in terms of whether it's discretionary or whether it's a staple. The discretionary has fallen significantly. Part of that might be Tesla, because buying a car is considered a discretionary thing. But we are seeing how the stock market is responding to it. But that doesn't necessarily mean we're going to see that as a change in behavior. Yes, we expect to see some changes in behavior over the next year, but it's not nearly as great as what the sentiment data is showing it to be. In terms of other issues that are going on, keep in mind that the main reason for tariffs, aside from one of the main reasons that we hear, is the fact that the president would like to reindustrialize the United States. And this is an interesting chart here on the left-hand side. The shaded area that you see is measuring the aggregate percent change in overall GDP, how the overall economy is doing. The dark blue line is measuring the manufacturing output that we've had. And you can see from 1950 up until about 2000, it was outpacing the growth of the economy. And of course, that makes sense. I mean, following World War II, we were the manufacturer of the world. And it continued to be that way because as time moved on, the manufacturing output became more and more sophisticated in terms of being focused on products that had a great deal of profit margin, sophisticated things like automobiles, things like pharmaceuticals, that sort of thing. But ever since China joined the World Trade Organization, you can see that dark blue line. It pretty much hasn't moved much at all. Meanwhile, the service part of the economy has continued to accelerate and now is accelerating at a faster pace. And this is what the president would like to do, is change the trajectory of that dark blue line. It's going to be a slow-moving process. You can see here on the right I mean, we've lost about 8 million jobs during that period of time from about 2000, 2015 in terms of the manufacturing. The chart on the right is just focused on a more acute period of time. You can see where the job growth was quite strong coming out of the pandemic. And that's because the demand for an awful lot of goods was strong, because that's what people wanted to keep their family amused when they were home 24/7. Although the vaccine changed that demand quite a bit, there were inventory levels that were extremely low, so the demand for manufactured goods remained high. But once those got filled, you can see how the manufacturing employment has pretty much not grown at all. And this, of course, is what the president is trying to change. In terms of credit card concerns, we get a lot of questions about this. Almost every meeting I have revolves around this issue, because when you enter a period of uncertainty, people are quite concerned about credit. The chart on the left just shows the growth in credit card balances. The data goes back to 2005 from the New York Fed. And you can see at $1.2 trillion, we're talking an awful lot of money. Keep in mind that this is not adjusted for inflation. The light blue line is adjusting it for inflation, those balances. And you can see it really hasn't grown much since 2005. Furthermore, keep in mind that people are earning a whole lot more money. And that's really the issue, that when you're issuing credit, that's the concern. Are you able to make that payment even though you're charging more? Well, yes, because when you take a look at those balances and compare that to disposable income, which is the money you have after you've paid your taxes, it's well below the long-term average. But they read headlines on their phone in terms of the fact that delinquencies are moving up. And true, they have been moving up. But as I say, the devil is always in the details. What's moving up? Well, it's those lower lines of credit is what's moving up. The New York Fed does a ton of research on this. And the most recent report that they had on that is that, yes, we're seeing delinquencies move up on people that have maxed out their credit scores, and they tend to have a low FICO score. So the line of credit might be $5,000, and they're seeing delinquencies rise on that. That's not so much of a concern for the economy. You know, the average credit card line of credit is around $20,000 to $25,000. Of course, there are people that have much more than that. When those start to move up, that's a concern, but that's not what's happening. Generally speaking, credit concerns, especially on credit cards, are not much of an issue until the unemployment rate gets to be very high, in which case they don't have the means. People do pay their credit card if they can, because they know that their whole life is spent having some sort of line of credit, whether it's a mortgage, a car loan, or credit card, or whatever it may be. So they do the best that they can to make those payments. So until the unemployment rate starts to shoot up, and by that I mean, above 5.5% or 6.5%, credit is not much of a concern for the financial markets. But I just want to end on these key takeaway points: is that the macroeconomic fundamentals is what's going to drive this economy. The unemployment rate is extraordinarily low, and as a result, that's helping to drive consumer spending. Yeah, there may be some changes, but keep in mind that the long-term average on the unemployment rate is around 5.5%. We're a long way away from that. So the risk of it being that high is not that great. And we think that that's what's going to continue to drive growth. Yes, though, we'll continue to see uncertainty. That's the president that we chose to elect. That's the thing that he thinks is most important in terms of negotiation. So that will continue to stay in the news. But the underlying fundamentals, we think, is what's going to drive the economy. And our outlook is that it continues to be quite positive going forward. There are no shocks that are coming into the system at this point. The Fed is not tightening policy. In fact, they're easing monetary policy. Oil prices are lower than what they were on average from last year. And we're not getting outside risks from other countries. So our view is quite positive. So with that, what I'd like to do is turn it over to Mike to give us an update in terms of what's going on in fixed income. Mike?
Wonderful. Thank you, Paul. So I'll start with the Fed today. And so at the March 19th meeting, the Federal Reserve left the Fed funds rate unchanged at 4.25% to 4.5%. And they also updated their summary of economic projections with changes to the macro environment that included revising GDP growth down from 2.1 to 1.7%, while both inflation and unemployment were both adjusted slightly higher. So in the press conference, Chairman Powell also emphasized that economic uncertainty is very elevated, and he stressed that there's really no hurry to make any adjustments to policy. And if we look at the blue line in the chart on the right, we can see that the Fed continues to expect 2 rate cuts this year. While this was expected, the updated projections indicate that the Fed expects growth to be weaker and inflation to be higher, at least over the near term. And the dark blue line on this chart shows the Fed funds futures market. And this reflects how market participants think the Fed funds rate will change over time. And here we see expectations have shifted from expecting 1 cut this year to pricing in 2 to 3 cuts, which are likely going to happen in the second half of the year. And so this policy uncertainty, it's also evident in the US Treasury curve. And here the light blue line shows the curve on January 14th. And this is when the 10-year Treasury peaked at 4.8%. And this was right at the time that the market was balancing these expectations for strong economic growth and the potential for an inflationary impact from the second Trump administration. But you can see over the last few weeks that the front end of the curve continues to be anchored by Fed policy, but longer-term yields have moved sharply lower, anywhere from 30 to 50 basis points. And this is because of that uncertainty around tariffs and the probability of a slowdown that have become more prominent now than concerns about inflation. So if we turn our attention to credit, here we're looking at spreads in the corporate bond market. And spreads really reflect that extra yield required by an investor to compensate for taking on risk. And so the top line here, it shows the spreads in the high yield corporate market, and the bottom line, the investment grade sectors of the market. And what we see is that after reaching recent lows, softer data, the tariff headlines, elevated policy uncertainty, they've created this climate of caution. And so this has passed through to wider credit spreads. So in the investment grade space, we're seeing spreads that are wider by about 15 basis points and roughly 50 basis points or so in the high yield markets. And so despite this move, we continue to see and believe that credit markets are resilient, even with this rising uncertainty. And this strength is supported by good economic growth that is then reflected through healthy credit fundamentals like leverage ratios, interest coverage, and operating margins. And so we see this return of the risk premium as a normalizing in spreads from historic lows. And this in turn translates into more reasonable valuations and what we think are opportunities within the asset class. So while we see better opportunities here, we do continue to remain cautious in the credit markets overall, and we are neutral weight in our portfolios relative to most benchmarks. And now, if we switch gears and we look at correlation, and here we're thinking about how stocks and bonds move in relation to each other. And this relationship is important because it's an important part of portfolio diversification and risk management. And so historically, we think about stocks and bonds being negatively correlated, meaning they tend to move in opposite directions during times of stress. But recently, we've seen how this relationship can break down. And we can see this in the chart on the left, where we look at the relationship between the Intermediate Government Credit Index, and this is an index comprised of government securities and corporate bonds, and the S&P 500. And what we see is that over long periods of time, this relationship holds, but it broke down during the pandemic when inflationary pressures helped turn correlations positive. And we started to see stock and bond prices moving together more frequently. So recently, as inflation has eased and markets are a little bit more focused on the potential for slowing, this relationship between stocks and bonds is normalizing, and the benefit of owning bonds is coming back into play. And so if we look at the chart on the right, we can see this as bonds have provided a hedge to some of that broader equity market volatility that we've been seeing this year. And so in addition to bonds showing, the benefits of diversification, yields in the market today remain at levels that we haven't seen for at least a decade. And this is important because starting yields tend to be the primary driver of future returns. And so on this page, the dark blue bars compare starting yields compare starting yields with annualized returns for the 10-year period before the Great Financial Crisis and the 10 years after. So what we're really looking at here is a higher yielding environment with an environment where the Fed had short-term rates near zero for much of that period. And what we see when looking at short treasuries, taxable and municipal bonds with intermediate maturities is that over the short term, returns are going to vary. But over a long horizon, returns are going to be influenced by that starting yield. And higher starting yields, a lot like what we're seeing today, are offering a more compelling opportunity in the market. And I think a second takeaway here is that while short-term cash yields are attractive, over the long term, what we can see is that adding a little bit of duration or extending the average maturity of your portfolio is going to tend to outperform cash or short-term investments. And so if we look at the environment that we're in today, we have long-term yields that are range-bound around 4%. We have the Fed that's on hold and unlikely to bring rates back to zero when cuts do begin again. And what this does suggest is an opportunity for favorable returns. And so in this chart, we look at the return potential over the next 12 months for short treasuries and again, intermediate taxable and municipal bonds. And so if we start with the bars in the middle, we can see that should rates remain unchanged, investors are going to earn their yield. And we would expect returns to be in the low fours for treasuries and taxable bonds, and then in the low threes before adjusting for taxes in municipals. However, should rates decline, we see an opportunity for better returns as bond prices will move higher. And should rates move higher, the higher starting yields should cushion volatility, and we will still end up with positive returns. And so to summarize, after leaving rates unchanged, the Fed is really in no hurry to cut rates given the recent uncertainty. The Treasury curve has reflected these concerns, and we've seen the yield curve shift lower. Corporate bond market spreads are somewhat wider, but continue to point to solid credit fundamentals and good economic growth. And finally, bonds are starting to behave like bonds again, and this is helping cushion volatility, while the higher starting yields that we're seeing offer potential to enhance long-term returns. And so with that, I will turn it over to Joe. Thank you.
Great. Thanks a lot, Michael. I'm Joe Handelman. I'm the head of equities at Rockdale. And at first, I'd like to take a global perspective on the equity markets. I sit here every day in my office looking at the U.S. market flashing red continuously, basically. But if we look globally, the rest of the world hasn't had that problem. Europe's up, close to 15%. Asia ex-Japan and Japan, EM, have been doing fine year to date. And so if we sort of play which one of these lines isn't like the other, it's really the U.S. market which has been underperforming year to date. If we dig deeper into the U.S. market, we can see that there is a return differential across the cap spectrum. Large caps have outperformed, mid caps have outperformed smaller caps. And as some of these fears kind of work their way into the equity market, that the other people on this call spoke about. These small caps tend to be a little bit more rate sensitive, a little bit more credit sensitive, a little bit more sensitive to beta. And so, if there are fears sort of permeating, these things are kind of reflected in the equity markets. Interestingly enough, though, the U.S. equal weighted index has outperformed the cap weighted index, meaning that if you just invested in large caps, kind of equal weighted across all of them, that's been the best investment so far this year, and it's been basically flat. If we dig a little bit deeper into that sort of cap rotation, let's look at last year versus this year. Last year, the Magnificent Seven ripped, the Amazons, Facebooks, Microsofts, Apples, NVIDIAs, had a spectacular year last year as AI themes permeated the market, followed by mega caps, so the largest 100 stocks in the U.S. market, then by the asset-weighted S&P, and then the equal-weighted S&P. We see the exact flip this year within the markets. So basically a rotation out of the large mega caps into sort of equal-weighted S&P. Right? So you can see the chart on the left is monotonically decreasing. The chart on the right is monotonically increasing, as we have this sort of rotation out of mega caps back into the broad equity markets. We also see this when we look at styles within the U.S. equity markets. So last year, growth had a spectacular year. Growth companies are companies where most of the earnings are reinvested back into those companies to help grow the companies. A lot of those are companies that invest heavily in R&D. So technology companies, healthcare companies that are doing pharma research and biotech research. This year, again, we see the opposite of that, right? So value companies who are a little bit cheaper on their multiples, who pay out more of their earnings, have outperformed, and the growth companies have suffered. So on a style rotation basis, we've also seen the 2025 equity market sort of revert back from the 2024 equity market. And if anybody's been invested in, dividend strategies or income strategies, you probably benefited from this value factor gaining year to date. It's been a good market for that this year. Another place we see rotation is defensives versus cyclicals. So high beta cyclicals outperformed in 2024. In 2025, defensive sectors have typically outperformed staples, healthcare, utilities. So again, on the beta front, on these different axes, we see a major rotation within the U.S. equity markets, which is a little bit surprising given that we've had 25+% returns the last couple of years. But at some point, you have to respect higher valuations, and these markets do tend to revert. That, coupled with some of the policy implications that we've heard so far on this call, sort of lead us to where we are in the markets today. But cyclicals underperforming defensives in 2025. Let's look at one more measure of rotation. We're going to go even deeper now, granular into each of the different sectors. The chart on the left-hand side shows the 2024 versus 2025 performance of each of the different sectors. And not the absolute value is really that important, but really the trend of the line, right? You can see the line is decreasing, meaning that sectors that performed well last year are lagging this year, and sectors that lagged last year are performing well this year. If we go one step more granular into industry groups and down into industries, we see the same exact trend, right? So this permeates the market in general. The bottom chart on the left-hand side, the scatter plot, again, is downward trending, showing that industry groups that fared poorly last year are doing pretty well this year. On the right-hand side, we have the year-to-date performance of each of the different sectors. Again, what we notice is, healthcare and utilities, defensive sectors have outperformed. Your more equity market sensitive sectors, information technology, consumer discretionary, have underperformed. And a lot of that is driven by single large stocks in each of those sectors which have underperformed. In comm services, you have Facebook and Google. In discretionary, you have Tesla. In information technology, you have NVIDIA. And these large growthy companies can really influence those sectors. Now, although the overall market is negative, I would say that 7 out of these 11 sectors are positive. So if we look at sort of a breadth basis across the U.S. equity markets, it's a lot less dreary than if you're just looking at the S&P 500 number every day. So there's some hope and optimism under the hood. In terms of our positioning, we have been underweight technology since the beginning of the year, and that sort of has helped our core performance in a number of our different portfolios. That's something we may close at some point, but sector allocation has contributed to our performance versus our benchmarks so far year to date. Another thing I like to look at, even more pervasive, are sector neutral factors. So if we just look at growth versus value, you can have a lot of industry bias there, right? So technology companies tend to be very growthy, tend to be very large. Energy companies are more value oriented. So you might actually be looking at differences in industries as opposed to differences in styles. But if you go into each individual sector and you split those sectors up by the largest and smallest companies and the most expensive and cheapest companies, you can create what's called a sector neutral index. And this is why you neutralize the effect of any one sector dominating your signal. And when you do that, you get the chart on the left. So I look at value versus growth, high momentum versus low momentum, high quality companies versus low quality companies within each sector. Small size, so small technology companies versus large technology companies, and small healthcare companies versus large healthcare companies. and those which are beta sensitive. And we do that, again, we see this theme of low beta companies, defensive companies outperforming from the end of February through present date. We also see for the entire year, smaller companies, larger companies underperform smaller companies as that yellow line decreases, right? So even as we permeate into each of the different sectors and build sector neutral indices, these things are pretty pervasive within the market. On the right-hand side, this is a chart that I like to look at. The light blue line is the Mag 7, the Magnificent Seven, these large tech-heavy companies. And the line, which kind of jumps up at the top, the grayish line, is a stagflation basket of companies that perform well during periods of stagflation fears. And so that basket has done well the last couple of weeks, as there have been fears of growth slowing, but inflation being kind of sticky, with the Fed in a holding pattern, as Michael showed us. And so that basket has taken off as the Mag 7 has gone down. And the way that we've played this, like I said before, is by generally being underweight technology for most of the year, which has been beneficial for performance in our portfolios. So if I kind of sum up where I think we are, what the backdrop is for the equity market, and what leads me to think about positioning within equities, growth is slowing, but it's still healthy, right? The unemployment rate, the labor market is still pretty healthy, but we do see growth coming down as the Fed sort of revises its estimates. Inflation is cooling from high levels, so we don't have that really high spiky inflation we had post-pandemic. It is cooling. We are above trend still, but it's coming down as the Fed has sort of went through its hiking cycle and just, reverts a little bit. We've had 2 years of incredible equity returns, right? So the last 2 years have been 25% plus equity returns, incredibly strong. That has left us with high and expensive equity market valuations. That's something to consider when thinking about equities going forward. My personal view is the Fed is more likely to cut than hike at this point. I think the labor market and the slowing growth concerns might be a little bit more on the Fed's mind than inflation. We'll see how that plays out. And to the degree that the equity market appreciates, I think it's going to be earnings growth over multiple expansion, right? So I still expect to get around 6% earnings growth this year, with multiples kind of staying flat and coming down a little bit, right? So this is the general backdrop that I see. What does this backdrop imply for how we should be positioned within equities? The places where I think we should be generally overweight are in some of the more defensive sectors. So consumer staples, energy tends to be very cheap right now. So like I said, we have high valuations kind of across the board, except energy is a little bit more attractive. Neutralish, I think you have your large growth sectors, so information technology and healthcare. We are underweight infotech right now. We might adjust that at some point as the market normalizes. And underweight credit sensitive sectors, so financials and utilities tend to be a little bit more credit spread sensitive. As growth kind of slows, spreads may widen a little tick, and I think those sectors will be hurt more than the others. But one thing I'd really like to stress is that within each sector, there are spreads that you can be taking, right? So like we drilled down to the industry groups in some of my previous charts. Within technology, I like software over semis. I think the benefit of AI is now going to permeate into the software industries, and semiconductors is going to cool a little bit as we have some of these DeepSeek events. In industrials, I like commercial and professional services over cap goods. And within staples, food, beverage, tobacco, kind of your mainstay staples over distribution and retail stuff that's a little bit higher beta. So I do see these as sort of the next 6-month sector and industry group positioning within equities. In general, though, we'll go over some takeaways. The market is in rotation now from last year as tech mega caps revert back down. General large caps tend to outperform. We see value as the leading style, and we see defensives over cyclicals this year, which we haven't seen for the last couple of years. I think that small caps have some headwinds in front of them as rates stay sticky a little bit higher and credit spreads widen. The AI theme, Charles talked about this, is going to remain strong. There is going to be some reversion back down, as some of these things have shot up to the moon. I think they'll normalize, but overall, the productivity increases will permeate across different sectors, and there'll be benefits across the market as it comes to AI. So in general, I expect average-ish equity returns this year. I know the market started kind of down. I'm a little more optimistic than maybe some of my colleagues and some of my peers, but I think the overall equity market will be average, and the place where you'll be able to take advantage is within sector positioning. And so with that, I will turn it over to Elizabeth for Q&A.
Thank you, Joe. A quick reminder, if you have a question, you can submit it in the Q&A console. And it looks like we have quite a few to get started with. Charles, we've had a number of questions on this. We've seen European equities outperform the US in the first quarter. City National Rockdale remains underweight. What are some of the signals that we are looking for out of Europe and maybe even Asia that would lead us to add exposure in client accounts?
Sure, perfect. And I think it's been the story this year in terms of how quickly it's occurred, and certainly some of the reasons for why it's occurred. So I think the first thing that we're trying to figure out and really understand is defense spending and how relaxing the constraints on borrowing in the Eurozone is going to propel things forward. I think it's very early. We don't know how it's going to overall impact domestic infrastructure in each individual economy. Will it be efficiently used? Is it going to be invested in the right areas that would provide prolonged growth? And what sectors is that going to impact? Are we going to continue to see defense really drive the bus here as other sectors lag internationally? Or is that going to shift, and will there be some sort of tangential effect in other parts of the market? And then what are the rules of the road going to be going forward? So for the next couple of years, those constraints on spending have been relaxed, but will that continue? And what will we see when different countries start borrowing more and more, and how that filters through to the European perspective? I also want to take a look at European rates. So the unsung story here is that similar to what we experienced in 2022 with the spike in our US Treasury rates, we're seeing some massive increases in rates along pretty much every single country in Europe. So how does that start to impact growth? And then if you follow that through, can the ECB and the BOE, the European Central Bank and the Bank of England, can they continue on their easing cycles, which has been a tailwind here at the start of the year? I'm not so sure that can happen. The other component here, we're dealing with it, but how will tariffs and US policy actually impact these economies? So overall, based upon the foundation that the US has versus the tariffs that will go on other parts of the countries that are dependent on the US, how's that going to impact things? So I think that's an important signal to watch and something that we haven't seen flow through yet. The other component is corporations and earnings. So growth overall is still expected to be pretty low in Europe. We've had a little bit of a turn here in profitability and expectations, but it was still flat in Q4 of last year. Although those expectations are climbing a little bit, we still have to watch that. And then finally, the geopolitical situation. So we think the environment has been improving a little bit there, but will that last? And then how is Europe going to be involved in the overall resolution there? So there's still a lot to be determined with how Europe is going to move, especially moving forward. And then how all of this tariff and US policy is going to filter through. But we're evaluating it every day. We're taking a look at it. It's certainly an area that we could be investing in the future, but we don't think those conditions are really right at this point for a long-term structural move.
Thank you, Charles. Paul, the next question is for you. You spoke a lot about the strength of the consumer, but between policy uncertainty, possible federal spending cuts and layoffs, do we have any concerns about the wealthier households? They've really been driving spending. Do we have any concerns about their spending starting to weaken?
Yeah, that's an important point. There's an article in the Wall Street Journal a few weeks back from Moody's, and it's just showing that the top 40th percentile does 80% of the spending. The top 10 percentile does 50% of the spending in the United States. That's what's been driving the growth. This is the upper trajectory of the letter K that we talk about in our K economic cycle that we're in. The income will probably be relatively constant for this group as we move through changes in terms of government payrolls and so forth. The big question really at that point is the stock market. We've seen, a 10% reduction in stock prices this year and a bounce back since then. As long as people continue to feel wealthy, we imagine their spending will continue to move in that same direction that it has been. So we're not overly worried about that aspect of the economy.
Thank you. Mike, turning to you and maybe focusing on the muni bond market, do we see any impact there from recent policy proposals?
Yeah, thanks, Elizabeth. Excuse me. Yeah, and I think, reform efforts by the Trump administration, are starting to hit the muni market. And really the headlines have focused on two areas. First is the potential repeal of the tax exemption, and I think this is going to come into bigger focus when the House works through the tax reform and debt ceiling issues. This does come up frequently over the years, and while it feels like it has a little bit more teeth to it this cycle, we do think that there's still a very low probability with the overall loss of the exemption, just given the importance of the exemption, how it helps finance critical infrastructure, across state and local governments, across the country. The second area that we would likely see it impact is various sectors of the market. So, for example, Medicare cuts could flow through to states and hospitals, or potential expanded taxation on university endowments, or even research cuts could hit higher education. We're still in the early stages here, but overall, we think that the issuers have the tools and capabilities to navigate any uncertain environments that are going to come in the next several months here. I think the most critical thing here is that it's important to have an ongoing and a robust credit process to really navigate this. And this is going to help us, find opportunities, but also, avoid any kind of unnecessary risks.
Thank you. And Joe, question for you as it relates to, fears of stagflation and recession have been rising. You mentioned the importance of diversification and balance in our equity positioning. What are some of the key market indicators or signals that you follow, and what are they telling you at this time?
Yeah, I mean, when I think about, are we heading into a stagflation environment or a recessionary environment, I really think about 5 different things. U.S. equity markets, we've seen what those have done so far year to date. Global equity markets, they've been just fine. Credit spreads, they really haven't widened all that much. The yield curve slope, there hasn't been too much in the ways of an inversion there. And the U.S. dollar hasn't really gotten much stronger as people flown towards quality assets. I haven't seen that. So maybe, I'd say 4 out of the 5 different indicators aren't really pointing to something detrimental in the equity markets. When I think about what the big event is for equity markets so far this year, I'd say it's more along the DeepSeek lines as opposed to tariffs and some of the economic stuff, because those companies are much larger in the index. They move the markets a lot more, and they cause volatility much more than some of the other stuff has. So that's basically what's on top of my mind.
Okay. And Charles, the final question is for you. Gold and silver have continued to hit new highs. Are they asset classes that we have any plans to add to as part of an allocation? I think we may have lost Charles, so we'll follow up with that question in the.
Oh, I think I'm back. The mute button came off. There we go. Sorry, thanks. So with respect to gold and silver, what we're looking for are traditional signs that would push it higher. One of those signs is a significantly weaker dollar, and then inflation that significantly spikes. So even when we take the tariffs into consideration and a lot of the policy that may be putting pressure overall on price levels, our estimate is 3.6% on CPI. So is that enough to keep that rally going? And then a lot of what's happened in those markets has been technical and based upon some of the forward contracts being converted to actual physical commodities in terms of gold and silver. So there's been a high demand for that physical transfer. And then I think there's also been a lot of speculation in that market. So when we're thinking about making an entrance and owning it in portfolios, I think on a pullback, we should be thinking about it in terms of how policy flows through. But at these types of levels, I think there's a pretty big risk of a pullback. And again, I don't see those historical traditional influences really pushing the prices higher. It's more technical in nature.
Great. Thank you, Charles. We're going to finish there for today. Thank you all for joining us. A brief survey will pop up shortly in your console, so please share your feedback and questions for future topics. A replay of this session will be available within 24 hours, and you will receive an email letting you know how to access it. Have a great day, everyone.